If you have a taxable investment account and you are not strategically using tax loss harvesting, you're missing out. You're missing out on a lot of efficiency, and you need to listen to this podcast.
Yeah, on this episode of the Abundance Mindset, we're going to dive into a concept called tax loss harvesting, as well as one called direct indexing, and talk about how those can improve your strategy for taxable investments.
I'm Allison, and I'm a CFP,
I'm Ben, and I'm a CRPS,
and
and
this
this is
is
the
the Abundance
Abundance
Mindset.
Mindset. Okay, so we've been recording these actually on YouTube now for about the last 6 months. This podcast is actually about 2 years old now, but we've only been on video for a few months.
Yes, and if you listen to all of our podcasts, I sound way better and way more intelligent in the first half of our episodes. And then when we went on video, just like this one, I've kind of lost my touch because video just makes me uncomfortable. I'm thinking about how I sound and look, and I think I just need to stop.
Yeah, so if you know Allison and you want to see her uncomfortable, you can you can
You can
watch
watch.
you can watch YouTube, because if you just listen, you go, well, okay, I reject that. I think you sound great and you do great. But yeah, you miss the days when we were slouched on our couches, just
Sweatpants.
cradling microphones and just saying what we want to say.
And I would write out a script because I care about the words that I use. And this I have to kind of freeform. So unless I'm in an actual client meeting, which I've also prepped for and written notes so that I use specific language so people can understand what I'm saying. Anyhow,
Yeah.
I'm freeforming and
Yeah, I think we'd both describe ourselves as type A personalities, but
very,
you're a different type A.
very
Uh,
type A.
I think I'm actually sometimes a little bit of a work type B, where I'm a little more comfortable just
Mm.
saying, yeah, like we're gonna say stuff, and if we say something wrong, we'll edit it out.
So yeah, Ben, on the other hand, just naturally has a really high vocabulary and sounds great on the podcast. I have so many of my friends who say Ben sounds so good. And I'm like,
I have
yeah.
heard I've got a radio voice.
Anyhow, let's just get into it with that big disclaimer.
Yeah. Okay. Today, talking about actually something we're really excited about, which is tax loss harvesting, and also talking about direct indexing. So, wow, those are two terms that if you aren't in the financial world, they mean nothing. So, we're going to get into those, but we're actually going to give a couple precursor terms before we get into that, just to make sure we're all on the same footing on what we're talking about.
So when we think about a taxable account, right, an individual account, a joint account, think non-retirement, right? So we're not talking about IRAs, we're not talking about Roth IRAs, we're not talking about your 401k. Those are really easy to kind of, understand. It's either going to come out tax-free, it's going to be all taxed at ordinary income, right? But when you get into taxable accounts, it's the most able to be manipulated account, in my opinion. And there's a lot of planning in this space, the taxable investment. There's ways to, depending on how much we can control your income, even get long-term capital gains to be 0% when someone sells out. It could be 15, it could be 20, but along the way, there's strategy that we want to use to help us now and long term to save on taxes. And when we're talking about taxes, we're talking about short-term capital gains and long-term capital gains. So short-term capital gains, that's securities that you've held less than a year, right? And either it's spitting off a dividend or income or you're selling it, and that's short-term capital gains. So, and that's going to be ordinary income. And then there's long-term capital gains, securities you've held past a year, past 1 year.
Mm-hmm. Yep. And long-term capital gains are, there's a few different tax brackets. They have a separate tax bracket from ordinary income, but they will be taxed at current code either 0%, 15%, 20%. And then depending on your ordinary income, you might be subject to the net investment income tax, which is an additional 3.8% on top of whatever 0, 15, or 20% capital gains you're already paying. For most people, particularly high earners, that tax bracket is less than your ordinary income tax bracket.
Yep. And these strategies can help with all of it. And
Yep.
so really important, a little bit more, I would say, a nitty-gritty of an episode, but really important. So I hope you stick with us. And today we're going to talk about, we're going to start with tax loss harvesting, which first, just back up. I want you to think about in year tax savings. So in your tax savings, I'm thinking, okay, I have a taxable account. What are the actual holdings that I have in this account? Are they, we use a lot of stocks and ETFs in this kind of account versus we would never use a mutual fund in a taxable account. We're not anti mutual fund. Generally, we don't use them, but we would never use one in a taxable account because what does a mutual fund do? It has to spit out income at the annually, and so you can't control it. And there goes your tax planning right there. So it's literally spitting off income to be taxed.
Yeah, yeah. To put a finer point on that, so mutual funds from a regulatory perspective, they have to distribute gains that they acquire, right? So if they do well, they have to distribute that to you. And on the other hand, a stock or an ETF, it is up to you on when you want to sell or buy them, right? Or it's always up to you when you want to buy, but it's up to you when you want to sell and realize, right? But in mutual funds, even if you don't sell, you will get additional taxable gains or income in some capacity.
So that's just the baseline. This is just the baseline looking at my account. What am I holding? Okay, let's make sure we're holding the right kind of securities. And then when we get into describing tax loss harvesting here, there's a couple purposes. One, it could be to try to offset other gains, which is really useful. So using losses to offset other capital gains, that can be extremely useful. Or just long term, let's say you're a high income earning accumulator and you just want to use some of those losses to kind of push your basis of the account up, right? While it's still growing, you're still investing in pursuing gains, but you're trying to reduce that long-term capital gains rate tax bill.
Yeah, and I want to step back there for a sec because I think, Roth dollars are kind of intuitive. It's all tax free, right? Tax deferred dollars are kind of intuitive. It's all to be taxed at ordinary income when it comes out. I want to just pause for a second and think about $1 million taxable account, just using a number, right? I think a lot of people look at that and they say, "Oh, it's $1 million, and okay, I don't have to wait till retirement to use it. That's awesome." But when a planner and a savvy investment manager looks at it, um, they really are looking underneath the surface at a few things. First, like you were just saying, cost basis. So if the cost basis of $1 million taxable account is $1 million, that is actually $1 million that you could withdraw, right? Without any tax consequences because you are only taxed on gain. If your account's done well, let's say the basis, the money you've actually put in is 500,000 and you have another $500,000 of gains. Okay, now we've got a much more complicated tax picture. Maybe you've got a combination of short-term gains and long-term gains in there. Any withdrawal from that account is going to have tax implications. So you really need to look another layer down. And $1 million it can mean totally different things depending on what's going on inside of your taxable account. So we really want to be thoughtful with how we manage these accounts.
Yeah, so to break it down and try to make it as simple to understand as possible, tax loss harvesting. I once had a client say like, "It sounds great. I still don't know what it is." Um, it's let's just take two securities, right? And let's say we have a portfolio and I'm looking and I see that Nike is operating, they have a little bit of a loss. And it's kind of a volatile market, right? Which is a great time to do tax loss harvesting. So, okay, Nike's at a little bit of loss, and I'm seeing that either we have some other gains we want to offset, or we just want to, again, push this client's basis up so they owe less tax. So I might harvest or sell Nike, right? And then immediately go and buy either a like to like or a diversification security. So a like to like would be on cloud for, this example, right? So I'm going to say, okay, I'm going to sell Nike. I'm going to buy on cloud. So I'm going to keep investing, right? On cloud, it's a like to like. So we're still in the market. We're still growing, but now we have this loss that we can use on our tax ledger for tax planning purposes. One thing I just want to add is you can't go Nike to Nike, right? And just keep the loss in your back pocket, but then reinvest in Nike. There's something called the wash sale rule, right? You can't do that. And so that's why you're either going to like, or you possibly are going in a completely different direction with your new buy because you need to diversify and rebalance the portfolio.
Yeah, you got to think through it a little bit. The IRS doesn't allow just an easy, I see my Tesla stock's down, so I'm just going to sell it and buy Tesla again at the lower price. Like, no, it's a little too easy. If you buy the exact same security, or if the security is too alike, which there's kind of another set of rules around that, The IRS gives what's called the wash sale rule, which it doesn't get you in trouble, but it just disallows the tax loss. So, and any loss you might have thought you got from that sale is just wiped.
So I've captured that, I've harvested that. Or maybe instead of on cloud, maybe we have too much US large cap and we want to go buy an international, ETF or something like that. There's different kind of purchases you can make, but it's harvesting that loss. Now we have it. We got to keep it in our back pocket and then use it for planning later while we are still invested and, participating in market growth.
Yeah, and I think for a lot of people that have a lot of income, maybe multiple taxable accounts, perhaps equity from their employer that hopefully for them has posted gains too that you've been hanging on to, it can get a little bit overwhelming, but we have to think about losses and gains as a single ledger. So regardless of what taxable account, as long as it's tied to your social security number or your spouse's social security number, if you're filing jointly, it's all going on the same tax return, right? So you grab a loss from your diversified taxable investment, you grab a gain from your employer stock, like that all gets thrown into the same tax return. So really we're looking at losses and gains across an entire taxable portfolio, across
Mhm.
an entire, calendar or tax year.
Yes. Yep. Tax planning is big picture and it's how are all of your accounts working together. So again, this is where it always gets bigger and more holistic, but this is one way you can use just one strategy on one account to be really effective.
Yeah, and I think this strategy kind of sometimes gets a little bit under the radar because frankly it's like it's not super easy to pull off, and a lot of places in the industry either don't do it or do it pretty infrequently, like even like annually or quarterly, and it's a good strategy net net. However, the less frequently you perform it, the less opportunities you have to grab an opportune time, right? We saw the stock market pull back pretty dramatically in March, right? Into early April. And if you're just doing tax loss harvesting once, twice, three times a year, well, were you planning to do it or did you have the wherewithal to do it when there was a brief pullback? That pullback didn't last, 6 months. So timing really is important here. And at least in our experience, I don't see this done with a high degree of intentionality and frequency super often.
Right. Ask your financial advisor, are you performing tax loss harvesting? And then ask them how often. Right. And so, and that's something where if we're talking about again a taxable investment, I'm going to, let's say we're taking on a new client, I'm going to look at their taxable investment, I'm going to look at the statement, I'm going to see, of course, what are the holdings and how does that match with the overall portfolio, but then I'm also going to look at how has this tax wrapper been treated and what kind of strategies are in place, and a lot of times I'm looking at the statement and there's a mutual fund, right? And that right away is a big red flag. And then I'm looking at all the past, just this month we were looking at a statement and the prior month had some volatility. Rich, remember market volatility, that's a great time to tax those harvests like Ben was saying. And so I'm looking, I'm seeing I don't see any cells, right? I don't see any cells, which would indicate that potentially there's some taxes harvesting. It's kind of hard to tell. But nothing, just purchases, which is usually the client just adding money, right? And so that's where you want to look at the movement, right? What shares or securities are being traded, as far as diversification purposes, but then also from a tax perspective, what kind of moves are being made, and that's something that we just you're gonna want that on your account.
Yeah, and I think another sign in thinking of that particular instance, there were a couple positions that were 30, 40% down, and the statement didn't tell, in that instance whether they were short or long term. Either way, that couple had several taxable accounts, right? And either short term or long term losses would be useful in offsetting. So it's just when you start to see really large gains or really large losses on stocks that have kind of, we'll say, gotten out of control, it becomes harder and harder to get out of a position the greater the gain is. And so you want to be on top of this in an account, not um waiting for a big market movement to do anything.
So if you're listening to this and you have a large taxable account, you want to make sure that you have a plan. Markets have gone up lately as far as this, timing of this podcast, which is great, but that can also create a tax bomb inside of your taxable portfolio. And that's going to take some strategy to unwind without giving the IRS a big tip when you eventually sell out of the account. So we offer zero cost strategy assessments if you qualify, where we dig into your unique circumstances and help you determine what next action steps to take as far as your financial plan moving forward and whether that involves working with us or not. So this is a strategy that we use in a lot of financial plans. And so I hope as you're listening to this episode, you're thinking about the bigger picture of your plan and how this could relate to you.
Yeah. So we talked a bit about tax loss harvesting, right? There is a flavor of tax loss harvesting or a methodology that we really like that helps you, I would say, just get even deeper and just have more opportunities to tax loss harvest. And that's called direct indexing. So I'll admit for myself, it took me like 3 or 4 times of hearing this to have it really sink in. So hopefully we can do a really, really well explained one hit wonder of this. But tax loss harvesting is the umbrella concept, right? So what you were explaining just in terms of you've got a loss, you sell that loss, you buy a similar security, and kind of begin to continue to gradually step your basis up and also offset gains elsewhere. Direct indexing applies tax loss harvesting, but what it does is it uses single securities. So it's common to use ETFs or exchange traded funds in investment accounts. What these are essentially baskets of securities. So ETF fund managers are buying hundreds, sometimes thousands of securities within a single ticker. What makes tax loss harvesting difficult with ETFs is that you need, a large amount of the companies inside of that ETF to post losses in order for that entire ETF to go down. That totally happens even in bull markets, but it doesn't happen quite as frequently. With direct indexing, think of it as build your own ETF with single securities. So this one's pretty tough to DIY. This one takes a lot of administration, but what you're effectively doing in direct indexing is building your own ETF and actually set of ETFs, diversified across the market. And then, say, you've got 300 US large cap stocks and there's some that you strategically aren't holding because you're going to harvest into them. What you're doing is you've got 300 stocks moving up and down. And even if the market's having a great, month or a great quarter, you're inevitably going to have companies that just don't have a great quarter. And so you were just going to have a much higher, rate of opportunities to see companies go down, say, hey, maybe I want to harvest this loss to offset a gain elsewhere. And it just gives you, again, way more opportunities to tax loss harvest.
Yeah, I would say the precision and the control increase significantly. So think about, okay, tax loss harvesting, we got our foot on the gas pedal, we're chugging along, we're doing the thing. Direct indexing is like pedal to the floor. Because if we are looking at accounts and let's say we're using ETFs, right? We would have to wait for that entire ETF to post a loss to harvest anything to again have a loss ready for our tax ledger, when we want that at the end of the year. And so this is where you own all of the stocks. We go and we buy all the stocks inside of that ETF. So when clients look at their statement, they're going to see a lot more, but it's just because, same holdings, but different method, because now we can say, oh, these 4 companies, the whole ETF didn't post a loss, is still up, but these 4 companies, we can take those losses, right? And then tax loss harvest. And so that's direct indexing. It's getting a lot more direct. It's getting a lot more precise. I mean, it's leveling up the tax loss harvesting capabilities.
Yeah, and I think also it's important to say you mentioned something that I liked there, which is same diversified account, right? Like direct indexing is not stock picking because
Mhm.
what you're doing is you are building your own index or set of indices
Mhm.
with individual holdings. So still very diversified, high amount of holdings. We're not trying to like pick a couple winners and hope they do really well. No, we're expecting to have winners and losers because that's what happens in an index. You might say, Ben, do stocks really go up and down that much? Well, I'm glad you asked. We pulled some research on this. So according to JP Morgan in 2024, just looking at that S&P 500, that's not the market, but just an easy proxy. 2024, 71% of the S&P 500 experienced a drawdown of at least 5% at some point during the year. So actively tax loss harvesting with direct indexing, you're going to have 71% of the companies in the S&P have an opportunity to grab a 5% or greater loss. In 2025, that percentage actually jumped to 83%. And 31% of the index actually finished net down in 2025, which for those that have been following the market, 2025 was a really good market year. But still, 31% of the companies in the S&P 500 were net down Jan 1 to December 31st. So yeah, when you start to unbundle ETFs, a lot more opportunities start
Mhm.
to emerge.
Exactly. And using this type of strategy is going to help you create more of what the industry would call tax alpha, right? Alpha is kind of a fancy word for return. And so, as far as tax alpha, when we're talking about direct indexing, academic and industry research shows that this can generate an extra 0.5 to 2% annually in tax alpha or in annual after tax return, right? And so, especially if you're living in, we have some clients in California, right? These top, or if you're in New York, right? These top state brackets facing, a combined rate north of 40 or 50% on short-term gains, every dollar of loss harvested saves you 40 to 50 cents in cash.
Yeah, yeah. So when we're saying tax alpha, we're not saying, oh, these stocks magically do, 0.5 to 2% better, right? No, that's not the case. What we're saying is your after tax return is higher because we are taking gains off the table strategically, right? And then, like you were saying, for every dollar of gain that you take off the table, depending on your federal and state tax bracket, shorter long-term gains, we're talking about anywhere from likely 15% long-term capital gains. If you're very low income, you might be at 0% long-term capital gains, in which case we're having a different conversation. But we're talking generally about, we'll say 15 to 50% tax, depending on the type of loss that we're talking about and the length of time on the security.
Yeah, all of this, it's not taking gains off the table. It's just using your losses appropriately and custom tailoring your portfolio to your individual tax bracket.
Yeah, totally. And to your point, not taking gains off the table. However, you can clear space to realize gains and move that basis of your account, or even a separate taxable account upwards, right? So
Yes.
losses just give you space to realize gains without having to also realize tax.
Yeah. We want to keep as much of our money as possible. So when you're looking at taxable accounts, these are the strategy. This is why we're bringing these up because we want you to keep as much of your money as possible.
Yeah. So there are some niche circumstances where you want to even move beyond, we'll call it broad-based tax loss harvesting and into more niche strategies. This isn't for everybody, and it's typically for large sums of money and large, very concentrated or single stock positions with a lot of holdings. But there are things that we can do. So let's just say you've got, like we've seen this, I think of a client who has been in Google for a long time, loves it, and didn't work with a planner or us for quite a while, was sitting on a lot of long-term Google stock and a lot of gains inside that stock. When you got a lot of gains and you're like, oh man, like you know, I don't want to realize all of this tax just to get out of this concentrated stock. There are different things we can do to really accelerate tax loss harvesting. They're complicated, they're more expensive. That's why it's not for everybody, but there are ways to aggressively get out of stocks, i.e., generate lots of losses so that you can gradually sell your gains down without incurring tax. A lot of involves using margin, using long and short positions, so strategically, um, shorting positions while also doing long positions, so that whether the market goes up or down, you're going to generate losses either on the longs or the shorts. Again, kind of complicated, but wanted to mention it here because tax loss harvesting really can complex because it is so beneficial.
Yeah, so we're talking about something pretty niche. So we've discussed tax loss harvesting, we've talked about direct indexing, and then we for the clients who use this niche strategy, we're talking about we call it the tax loss maximizer, right? And it's to go back to the gas pedal. It's like tax loss harvesting is halfway there on the pedal, and direct indexing is pedal to the floor. Tax loss maximization, this strategy, we've named it, right? This is like ditching the car and going to the rocket ship because we're using, again, margin and employing these strategies tenfold. And so this is for people who have significant gains that we want to try to avoid paying as much tax as possible.
I love that analogy. That's great. So the point here is that great investment management is not just about picking good holdings. It's also about managing the tax ramifications of those holdings proactively. If you don't have a plan in place to manage taxes from your taxable investment account, you're going to end up tipping the IRS way more than you need to when you actually use that account. Like we've said before, I can't tell you how many times we've looked at accounts where the holdings have done really well. And from the client's perspective, they're super happy about that. And like this is a hashtag good problem, but it's like, oh, you didn't actively your previous advisor or you didn't actively step the basis up. So this account is actually worth less after tax than it
Mhm.
could. And I think that's just the thing people miss so
Mm.
often in this space.
Well said. Everything takes planning. Everything takes planning and paying attention and looking at all the tools that you have in your plan and saying what's the best thing I can do for this account specifically, but then what's the best thing I can do for that account specifically within my whole picture. Because again, especially when you're getting into tax planning and strategies, you want these things to work together, to dance together and play well so that you can keep your money.
Yep, 100%. So, like we often say in this show, our heart's for people to take action that's beneficial for them. If you've been listening and you have a large taxable account or one that you know has a large gain in it, we offer those complementary strategy assessments that you talked about, Allison.
So if you're listening to this and it's resonating and you want to, take the step and saying, "Hey, am I employing any strategies in my financial plan? I really need to, get things, humming the way that they should." And so, go to our website. You can book a consult and fill out a little bit of information about yourself. And then just have the conversation to see, what does it look like for me to, either switch advisors or start a financial plan and just start to tune up the car, right? And then we can start pressing down on the gas pedal.